volatility out there, that's for sure. But you know what? Who's going to give us a great rundown on the week is Jay Pulaski. How are you, Jay?
Great, Scott. How are you, buddy? Missed you last week. Was thinking about you when I had my second plate of turkey.
Well, I was cooking with 17 people, so I was very much buried in the ovens and out in the grill. So it was a great
Oh,
week, though. But it's
are
great
you
to.
telling me you weren't thinking about me? Is that
I
it?
was
That's
thinking
okay.
about you on Friday as I was watching the US soccer team play against England.
There you
But
go.
let's move into your monthly musings because I it's sort of all of a sudden here we are in December. The weather started to change. It gets a little bit colder. My voice gets a little croakier. Talk to me about the title of this one, Enjoy the Downhill, because surely you're not talking about the markets going downhill.
No, as you know, we've been pretty constructive and are feeling pretty good about how things are playing out. So yeah, this is the monthly, and again, as a reminder to the audience, 4,000 words, 21 charts and tables this time from about a dozen different sources. So a heavy duty body of work, and basically, we start off by talking about how there's a change in the air, how the old stories of shortages and rising case counts and rising prices, rising rates, rising dollar, all that stuff is now seemingly kind of old and stale and kind of tired. And to use that phrase, from tired to wired, what's wired is a sense of declining prices, falling rates, plenty of supply, normal holiday season. And that's to us is the fresh stuff. That's the new stuff. That's the wired stuff. And I think it suggests that much of the bad news, don't want to say all, but certainly much of the bad news is in the price. And we talk in the monthly about, there's just untold number of references to extremely pessimistic sentiment reading, right? We write in the monthly about, hey, let's switch that and let's look for extremely bullish indicators. And we joke that, you need the Hubble telescope to find one, right? Because nobody's really bullish. I mean, the market consensus for next year is a flat S&P. And by the way, we think that sets up one of the big opportunities for next year, which is outside the U.S., right? If we're going to have a flat S&P, continued decline in the dollar as we expect, we think the dollar is rolling over and has significant downside to it. There's no better environment for non-U.S. equity outperformance than a flat S&P and a declining dollar. And so that's really one of the main takeaways of the monthly. And as far as the title, Enjoy the Downhill, I mean, that's kind of what we're trying to get to. Remember, in our monthly last month when we introduced our 2023 outlook, we said stability ahead with the question mark, right? Now we see more of that sign of stability coming forward. And stability should mean that animal spirits start to revive. And so enjoy the downhill. Well, I'm more of an après-ski guy. I mean, you and I could hang out by the hot tub together with a hot toddy while others ski, right? I'm up for that, by the way, if you want to do that. Others can do the downhill. But what we mean basically is that we expect continued decline in inflation, continued decline, though more modest in rates. We think rates are a little ahead of themselves at these levels, and a continued decline in the dollar. That's the downhill, and that sets up very well for positive risk asset returns, especially outside the United States, together with high yield, and together with two spaces that we think have been kind of been through the ringer, climate and innovation. We think with big tech going X growth that the market, as animal spirits revive, as stability returns, there's going to be a search for the new growth segments of the market. And we think climate and innovation represent good opportunities together with EFA and emerging markets for that search for growth. So that little more long-winded, but as you know, in a monthly, there's a lot to cover.
Yeah, you're 100% right. And I'm still a little bit rattled by you and me in a hot tub sort of vision. But let's move on to like breaking it down, how you do in your monthly. And I actually see you mentioned there in the climate side, COP27. We had a great series from someone from Kalyani in Puri who was on the ground there at COP27. Check out that series actually on our YouTube channel. It's fantastic, the insight she has there. But you see COP27 as a little bit of a disappointment for the corporate sector?
Well, disappointment kind of in that a number of the objectives, particularly around really phasing out coal, as well as dialing in on the targets for emissions by 2025 and 2030, weren't really addressed. And I think it's a little tricky, right? The climate summits used to be every 5 years. This was really the first one on the back of the one from last year. And so I think there wasn't a lot that really changed, because think about governments, right? Been very focused, and investors very focused on inflation, very focused on invasion of Ukraine, very focused on COVID in China. So it's been a too short a period, and people have been their attention's been focused elsewhere. And I think that latter point's really the key for us, right? We think investors have kind of taken their eye off the ball of climate, which we see as the single biggest global macro theme of this decade. That's something we've been saying for a couple of years. Climate is the single biggest theme. It's the only one where every government is spending money over a finite time period. And so one of the things that as we expect stability to kind of return in 2023, 2024, et cetera, we think investors are going to come back to the growth opportunity that climate represents. And that's certainly how we're positioned, particularly in our TPW20 thematic model, which is about 40% invested in climate-related ETFs.
Okay, I want to move on to the economic side of this. And the word recession, like we've spoken about it so many times this year. People have tried to change the definition of recession so many times this year. And that's the world we are in now. If like you don't like the definition of something, just try and change it. So, but where do you think we are on all this sort of side, on the economic side? Like, are we in a recession? Even if we are, does it matter? Like, are we going to spin right out of this?
Well, I think we're definitely not in a recession, right? I mean, Q3 GDP was just updated, annualized growth of 2.9%. If you look at the Atlanta Fed nowcast for Q4, it's running over 4%. And remember, we've been big believers and very focused on the high nominal growth world that we're in. That was one of the reasons that led us to be confident that earnings would be okay, which would be that bridge between decline, as we waited for inflation to really decline. And all that's kind of played out as we expected. So for us, one of the charts we had in the monthly is the most anticipated recession ever. And it's a great chart of how consensus this recession call is. Our view is that we think growth is going to be better than expected, pretty much around the world for a couple of reasons, right? First is that there's no major imbalances. This is what the super bears fail to grasp. There are no major imbalances anywhere really in the world, whether you think about the consumer, whether you think about corporates, whether you think about the banks. All those segments are in pretty decent shape. So we don't see the big downside that the bears do, either in terms of growth or in terms of earnings, and the two kind of go together. And so for us, we also don't see, by the way, a wage price spiral, right? I mean, the average hourly earnings in today's jobs report got a few people excited about that again. We point out in the monthly that Germany, which is one of the most heavily unionized countries in the world, which also has inflation of over 10% versus the 6 to 7, 8% here in the US, over 10%. Their single biggest union just had its wage negotiations and settled for a pay raise of 5% this year, 3% next year. There's not going to be a wage price spiral. And then the last point we want to make on the economic front, which we think is very important, is that China is clearly moving off of heavy-duty lockdowns related to COVID. This is critical, right? Because it means that the Chinese consumer is going to be unleashed in 2023, much as the US consumer was in 21 and the European consumer was in 22. There's a reason why Europe is still not in recession, even given the dramatic surge in energy prices. It's because the consumer came out and spent after being released from COVID lockdown. We have a great chart in the monthly showing the exact same thing as what happened in the US and in Europe happening in China, namely just tremendous cash savings because people are not going out and spending, right? That cash saving in the US, even after it's been run down through 2022, is still approximately $1 trillion, which is another reason why we don't think the US is going to go into a deep recession, perhaps not even any recession in 2023. But most importantly, when you think about global, is the fact that China's consumer we expect to be a major force in 2023 as they clearly move off the lockdowns of COVID that they experienced in 2022.
Yeah, well, China's obviously had a lot of publicity this week because of those lockdowns. As we move into the politics side of your note here, I feel like we've got through the midterms, right? There's European elections are sort of mostly done. Is there anything we should be concerned about going into 2023 on the political side of things?
Well, I want to just touch on your point about China and COVID, right? I mean, who would have thought a couple of weeks ago that if China were to report its record-breaking COVID case counts, who would have thought that reopening stocks would have led the market higher, right? And that's what happened this week. That's what happened this week. And it's, again, a perfect example of what we're trying to talk about. All the bad news has been so, overwhelming and so priced in and so expressed so often, as you talked about recession. Zero COVID lockdowns in China. I mean, every bear's favorite go-to outside the U.S. is COVID lockdowns in China, right? And so here we are with record-breaking case counts in China this past week, and the best performing segments of one of the best performing markets, which is China's equity market, is the reopening stocks in China, together with KWEB. You and I have talked about KWEB a bunch over this past year. You know we like it. We've held it through the downside, back into the upside here. I think today is like the third day this week where it's going to close 5 or 6% up on the day. It's up about 35% in the past month. So, wake up and smell the coffee, people. It's a big deal that China's moving off of zero COVID. So, again, a bit of a segue, but I think a really important point. In terms of the politics, again, we expect from the economic side, we expect stability to start to manifest on the political side. As you pointed out, midterms are over in the U.S. We've already gone through a military invasion in Europe, and in China, President Xi has achieved his third term. So where we expect to see a lot written about political risk is in the geopolitical side, where we have Europe trying to figure out where it wants to sit relative to this U.S.-China kind of, decoupling, right? Which the U.S. really put its foot down in the recent decision to ban high-end semiconductor activity with China. That's a direct attempt to cap China's technology rise, and Europe has to figure out where it wants to play in that space. And so there's going to be a lot written about that. For us, it reinforces our tripolar world, right? Our thesis that we've had for over a decade, that regional integration in Europe, Asia, and the Americas is how we're going to move forward in kind of the global architecture. This just reinforces all that. Clearly, we're having kind of separate camps set up. Everybody wants a fab plant in Europe. 4 have been announced in the last couple of months. Everybody wants a battery production EV plant in the US. No one wants to rely on China for that stuff. China can't rely on the U.S. for high-end semiconductors. So that regional integration, friend-shoring, near-shoring, etc., that's happening. It's a political fallout with significant economic implications because it really reinforces the CapEx boom, which is our kind of medium-term theme, as you know.
Well, so let's move on to policy. And it was fantastic to see Powell talk on Wednesday, and the market has ripped on the back of it. Like it's usually the other way around. But
yeah, exactly.
So are we at the end of this cycle now? Like I think it's too early to say at the end of the cycle. Like he could easily just keep saying it's 50, 50, 50. But you did seem to get the warm and fuzzies that it might be turning the corner, right?
Well, for us, what was interesting is that he kind of gave a serious head nod to the idea of a soft landing, which, as you know, we've been talking about the middle way, which is our version of the soft landing, to your point about if you don't like something, just change the name. You know, our name of a soft landing has been the middle way, right? The path between high inflation and deep recession. And Powell gave more credence to that. He said it was very plausible in his talk the other day, which is the best kind of support he's given to that thesis in quite some time. And so, look, again, policy, we expect more stability, right? There's no way the Fed is going to raise rates 400 basis points in 2023 as it did in 2022, right? So they may raise rates a little bit more, but I think, and you can see from the market reaction to today's jobs number, market's priced in a 5% terminal rate. It's highly unlikely it's going to be anything above that. It's possible it will be below that, but that's where the market already is. Again, already in the price. So monetary policy, we think, is kind of a done deal. No real surprises there. Fiscal policy, likewise, divided government in the U.S., nothing happening there. China already very clearly demonstrated they're not going to do any kind of huge fiscal stimulus. It's going to be small steps, like they just announced a 16-point plan for supporting the real estate sector, which, again, you know, is a big focus of ours as well. We have a Asia high yield ETF that has done, you know, up double digits over the last month because of that sense that China is putting a floor under the property market. So we expect more of that in China. And then in Europe, fiscal policy is active, and European governments will continue to spend to support their economies through the energy transition. And this is one of the reasons why we think Europe will also not go into a deep recession. Record low unemployment, fiscal support. Yes, the ECB is going to raise rates, but we don't think there's big downside to European growth. Could they go into a mild recession? Absolutely. Is it going to be deep? Highly unlikely. Is a mild recession already in the price? We think most definitely.
All right. Well, that wraps all in nicely into the markets and having a look at the markets. And listen, we've seen some extremely volatile days this year. It's as we get closer to the end of 2022, I know I'm ready just to tuck myself up with a little blanket in there, not in a hot tub with you. Just
darn it.
Myself.
I was thinking you were going to go there.
But what do you think for markets?
You ruined my vibe, man. Come on.
But what are we thinking here on markets? It's like the way we finish off the end of the year, like do we see this little rally through to the end of the year, do you think?
Well, I think as stability manifests, you know, kind of seasonality and history and those types of things start to regain some validity, right? We're coming out of, in our view, we're coming out of a 3-year period that is ahistorical, meaning not like history. We haven't seen the environment that we're coming out of in over 100 years. And there's enough different between today and 100 years ago to say we haven't seen it really before. And so as we come out of that phase, right, we come out of the COVID disruption, we come out of a super aggressive Fed tightening cycle, we start to see more stability that allows for things like history and seasonality, which is supportive of, a continued up move, is supportive of year three being the best year of a presidential cycle. All those things maybe start to gain a little bit more credibility. I mean, from our point of view, technically, things are looking better and better. The market has done a lot of work yesterday or the day before with Chair Powell's comments. The S&P, ACWI ex-US, and ACWI itself all broke above their 200-day moving average for the first time since the spring. For the S&P, it was under the 200-day for 162 days, the longest such streak since the one that ended in May of 2009, which I know you will recall because you got a little gray. I will recall was the low for the great financial crisis. So I think the odds are pretty good that the low is in for the. We don't see the case for a sharp slowdown in growth. We don't see the case, therefore, for 15-20% decline in earnings, which the bears are talking about. We expect a flattish S&P, so plus or minus 5%. The big story, as we said at the top, is that a flattish S&P and a weak dollar set the stage for non-U.S. equity outperformance. And we think we could be on the cusp of a multi-year run of non-U.S. equity outperformance. The markets in Europe and in Asia are at record cheap levels versus the United States. They're completely underowned. B of A's fund manager survey points out 41 weeks in a row of outflows from European equity funds. Meanwhile, Europe is up almost 20% over the last 2 months, the best performing region in the world, but nobody cares, right? Nobody cares. They're just like dug into the bearish vision. We're trying to push back hard against that. So we think better than, so we like non-US equity, IFA and EM, Europe, Japan, China, Brazil, Southeast Asia, etc. We like small caps and value and cyclicals in the United States. We like credit and fixed income, right? We think rates, particularly in the US on the long end, have gotten ahead of themselves in terms of the big rally. So we're cautious towards sovereign debt. We like credit. We have a great chart in the monthly showing the best credit environment in history in the United States right now, courtesy of B of A. But high yields 9%. 9% in the best credit environment in history, Scott. So we own a lot of that. Thank you very much. We own high yield in emerging markets, and we continue to be very constructive towards the commodity space. Weak dollar, very bullish for commodities. Low inventories, very bullish for commodities. Chinese cashed up consumers starting to spend, very bullish for commodities. So we like the commodity sector as well. And then finally, just to finish where we kind of started, as stability returns, animal spirits revive, we expect to see the innovation space and the climate space be the places where investors focus for new growth stories, right? Big tech in the U.S., another reason to think the U.S. is going to be an underperformer is that big tech in the U.S. is going X growth. It's not going to collapse like 2001 because they're cash generating machines, right? Buying back stock, paying dividends, etc. But that anchor, which was a rocket, is now an anchor, and it's 24% or so of the S&P. So that is a principal reason why we think the U.S. will underperform other parts of the world that don't have that, right? If you look at IFA, the number one sector in IFA is financials at 17%. So when you're thinking about portfolios for next year and you're looking for ways to generate alpha versus a benchmark, if you're a global equity benchmark, U.S. represents 62% of equity. 62%, all-time high, okay, because so many people have flocked into the U.S. over the last couple of years. That's an easy bogey to shoot against, right? Underweight the U.S. in equity, and I think over the next couple of years, you're going to do very, very well on a relative performance basis. Finishing up, we like the climate and innovation space, as we said. That's going to be the new growth area. Climate, because every government in the world is spending money on it. Innovation, because that stuff has been battle tested. 70% drawdown, 2-year bear market. Everybody kicked it to the curb. But guess what? Those are real companies doing real business, and now they're more attractively valued than they ever have been at a time when we think growth is being completely discounted incorrectly by the majority of investors.
Well, it definitely sounds like it could be a good old bull and bear challenge coming up. I might have to get Jeff Hughes back on a call with you.
Jeff needs to own up to his call, which has been completely wrong. But always happy to chat with him.
All right. Well, I'll leave that to you two to debate. I'll get Maddie to handle that one because I don't want to be in the middle of it. All right. Listen, Jay, you have a great weekend. Thank you so much for your time. Insights are great as always.
All right, Scott. Great to see you as well. And, that hot tub invite, it's open, buddy.
Yeah, you just jump in there. I'll be right there. For everyone else out there, good luck investing.